Okay, thanks. And thanks, Jeanette, for inviting me to Toasted Traders. This is my first time here, and I'm really looking forward to it. And you guys have been so professional in getting everything set up, and it looks like you're really running a tight ship here. So this is awesome. And it looks like we got lots of people logged in. And please, as I go through my presentation, ask questions and jump in with comments. I'd love to make it interactive. So I am Dean Jenkins. I'm the founder of FollowMeTrades.com. I run a stock advisory service, live trading room. I offer education. I'm a technical trader. I focus primarily on stocks and options, and I'm not a day trader, so I'm not trading intraday time frames, but a little bit longer trades. Short term for me is being in a trade, 3-4 days to a week or two, and a longer term trade then can be 4 to 6 weeks. So that's kind of my time frame and the instruments I'm trading. So I'm going to talk today about being the house, to having a trading edge. And what I'm going to talk about, I'll give examples on the kind of trades and instruments and time frames that I'm trading, but I want to share some concepts that I've learned over many years of trading and many mistakes and some good success that apply to any kind of trading, whether you're trading intraday, futures, options, forex, whatever you're into. I think these concepts are going to apply. After I get through just some foundational stuff, share some concepts, I'm going to show some demonstrations on live charts. I'll share a couple of my favorite trades, and I'd be happy to take a look at any charts, any symbols you're interested in, run them through my filter, use my analysis, offer my analysis, my feedback on it. So we're going to talk about, again, being the house, having a trading edge. Of course, I'm going to share some real trades that I'm in or some ones that I like. I'm not a financial advisor, I'm a trader. I'll share what I'm doing, but whether any individual decides to go make a trade, place an order or something, that's each person's decision. Only you know what's right for you, so I'm not giving financial advice, sharing what I do. Okay? I think, and I've learned, and I believe these things to the core of my being, that to be a consistently profitable trader, there are 3 things that are essential. Again, this doesn't matter what instruments you trade, what time frame you trade, what trading platform you use, what indicators you use. You got to have great trade setups. They have to be proven to have a high probability outcome, and the trades have to have a great reward to risk ratio. There are some trading systems that have a high win ratio, but a very poor reward to risk ratio. And boy, you gotta be really good and maintain a really high win ratio if your reward to risk, if the amount you make on winning trades isn't bigger than the amount you make on losing trades, if the amount you lose on losing trades is bigger than your winners, that's tough, right? And it's going to be tough to be profitable. So I think you need great trade setups, you need high probability outcomes, you need great reward to risk management, you got to have risk management, you got to control the downside. You have to determine what an acceptable loss on a trade would be, not be a big setback. And you have to have a method to make sure that on losing trades, and there are losing trades, can I get an amen? There are some losing trades out there, right? You have to make sure that it's an acceptable loss. And then when you're in a trade, you got to have a black and white predefined method of managing it. Where are you going to take profit? Where are you going to get out? When would you add in to a trade? And ultimately, where would you exit the trade? Those have to be all predetermined in advance, I've learned, because if you're figuring that out on the fly, emotion's going to play too big of a role, and it's going to undermine your results. So I'm going to share my approach to all these items here as we talk through this next hour. And we'll be looking at some real live charts here pretty quick. Okay, but first, let's talk about casinos for a minute. So here we are, we're looking at a craps table. We got some folks here, and they're just having a good time. It looks like they're all smiling there, they're rolling the dice. Got some alcohol involved, it looks like, and they're having fun. And I think if you go to the casino, you should view it as fun and as entertainment, and say you take $100 and you go, well, I'm willing to lose $100 at the casino, and maybe that's the same as dinner and a movie, and it was fun. If you go into a casino expecting to walk out with winnings, it may not be that fun. the smiles might get wiped right off of their faces if you expect to make money in a casino. Right? You might get lucky and win, but you probably should expect something different, right? But what about the owners of the casino? So we got these people down on the casino floor smiling, having a good time. Upstairs, we're off in an office somewhere. There are casino owners, and they're watching the cameras, and they got green eye shades on, right, counting the money. Are they gambling? These people down on the floor are gambling. Are the owners of the casino gambling? Absolutely not. They are not gambling. They are in business, right? And they absolutely ensure that they have control of 2 variables for every game that's going on down there on the gambling floor in the pit. Okay, and I got a question, and Dennis is asking, how do you get over hesitation and doubt before you enter? Let's hold that, Dennis. I'm going to show you on the chart, because I have about 5 criteria that need to be met before I take a trade, and I'll be able to show those on a chart pretty quick here. Okay, and so it really is, you know, how do I get over hesitation and doubt before I enter a trade? It's having predetermined criteria, make sure it is met, and it's having confidence in my trading system, which is generated from thousands of trades over the years. Knowing that if my criteria is met, that I've got a probability of an outcome. So the casino owners, they control probability on every game on the floor, and they control risk. How do they do that? Well, let's consider roulette. It's a super simple game. It seems simple. There's numbers on a wheel, 1 through 36. Half the numbers are black, half the numbers are red. So there's even odds, 50-50 chance of, you know, the ball dropping and landing on either black or red, even or odd. So it's got a 1-to-1 payout. You bet 10 bucks, and if you win, you get $20 back, your original bet, plus a $10 win. So it seems super simple. So here's a roulette wheel, and look at it, and you go, uh-oh, I see it, 1 through 36, red, black, red, black. What is up with those green spots? We got a green 0, and we got a green 00. What are those? Right? The 2 green spots, 0, 00, change the odds on a roulette wheel from 50-50 to 47.5 win probability per spin. So because there's 2 green dots, which is what they do on an American style roulette wheel, now if you bet on black, right, rather than having a 50-50 probability, you've got a 47.5% chance of winning as a player, and the house has a 52.5% chance of winning. And they make all their profit on a 2.5% edge, and that's enough. Over thousands of spins of the roulette wheel, the casino owners know they're going to win 2.5% more, you know, than they lose, and that's enough. And the thousands of dollars that change hands, right? More of it's going to stay in their pocket than yours. So they have probability on their side. And so they also control that they're profitable via another, they control probability by putting the green spots in, and they control risk. So probability is controlled versus the green spots, tilting that wheel just a little bit, 52.5% in their favor. They also control risk via a table limit. So if you go into a casino and you walk over to the roulette wheel, you cannot go put $1 million down on black because there's a 47.5% chance you would win, and that would be an unacceptable loss for the casino, right? You probably can't go bet 100 grand. You know, if you walk into, you know, various casinos and different gaming pits have different limits. You know, maybe it's $100, $200, but they figured out what, you know, what's going to be attractive to you to come play the game, but they limit the amount that you can bet, or the amount that they can lose on any given bet. So they're not going to take a big hit. They're not going to let you bet $1 million on black and maybe win, and now they've got a big setback. So it's pretty smart, right? Why not be the house? Why not have that same kind of confidence that the casino owners have, that over thousands of spins of a roulette wheel, the casino owners know with certainty that they're going to be profitable. They know that they're going to lose 47.5% of the time, but they're going to win 52.5% of the time, and they've controlled risk. They know that the losses won't be big. So why not be in that position with our trading? Why not know with certainty that we're going to be profitable over a large number of trades? And then when we get to that point, then takes the stress off of our trading because we don't have to worry about an individual trade. As long as we're following our rules, we're following our setups, we have probability on our side, we have an edge, and we're controlling risk. Whether an individual trade wins or loses is immaterial. We know some are going to lose, we know some are going to win. But we can do something also that the casinos can't do, and that is we can skew the payouts to our favor. So, you know, in roulette, nobody would play the game if you bet $10 and if you won, right, you got bigger odds, right? Or if you lost, you had to pay more, right? If you bet $10 and you lost, you had to put another $10 bill up there. You wouldn't do that. But we can do that in our trading by only taking trades that have, like I talked about before, a high reward to risk ratio. No, we don't need to take trades that only have a 1-to-1, you know, I could lose as much as I would win, or I could lose more than I would win. We only have to take trades because we're in control. We only take the trades we want to take. We only have to take trades that have a potential of making more money if they win than they would lose if they fail. That's pretty cool, huh? All right, so how do we do that? So I have trade setups that I use in my trading, and again, I'll share mine. It doesn't really matter. These concepts that I'm talking about having an edge and using risk control, apply to whatever setups you use, as long as they can be proven to have an edge. So I really use Elliott Wave as the core of my analysis. You know, some people roll their eyes at Elliott Wave and they've seen these super complicated chart markups and, you know, grand cycles and super cycles and, you know, what, and there's like 144 permutations of the classic approach. I use a super simple approach to this. I'm only trying to trade wave 3. I'm just looking for a big impulsive move. And then after a big impulsive move, what we see nearly all the time is a correction. And then after a correction, we see a continuation of the original trend. I'm only trying to trade wave 3 if I can catch a new trend breaking out. Wave 4, if there's enough profit in the correction. Wave 5, continuation of it. Okay. Elliott waves are subjective, says Redeem. I would disagree. Hopefully constructively disagree, because I've been successful using them. But I think I know why people believe they're subjective. And here's the mistake I think most people make with Elliott Wave, and that is they bring up any chart and then they try to count the waves on it. And real Elliott Wave tradable high probability setups are not on every chart. You can't force it on there. And when you start trying to force a pattern where it does not exist is where you run into trouble. So when I teach Elliott Wave, I teach people in about 1 second, maybe 2, when you pull up a chart, you should be able to see if there's an Elliott Wave pattern. If you can't see it that fast, it's not there. Move on to another chart if this is the technique you're trying to trade with. So that's my hopefully constructive response, Redeem. It works up and down. Now I look for confirmation of these waves. So the core of my analysis is in Elliott Wave, trying to catch an impulsive wave, a correction, continuation. Works exactly the same going down. Okay. I also use Dow theory. Simple, you know, this is just a slice of what Charles Dow wrote. But, you know, what's the definition of an uptrend? Higher high, higher low, higher high, higher low. As long as that pattern continues, you got an uptrend. Downtrend, lower low, lower high, lower low, lower high, lower low, lower high. As long as that's going on, you got a downtrend. When it ends, when you no longer put in new highs in an uptrend and you take out previous lows, pretty good shot, pretty good chance that the uptrend has ended or is at least correcting and beginning the corrective move, right? Pretty sweet, pretty sweet. Okay, we can determine when a trend begins with a high, higher low, new high. And that's exactly what the end of the bearish trend looks like, right? Bearish trend begins with a low, lower high, new low, lower lows, lower highs, lower lows, lower highs, till new lows are not put in, previous lower high taken out. Okay, so this is really, you know, if we're going to trade, this is super valuable information, and it seems so simple, but until you just kind of sit back and think about it, because if we're in a trade, we want to know if the trend is continuing, and there's you know, the potential for emotion is we're in a long trade and it's going up and we're in profit and it's awesome, and then it starts pulling back. We go, uh-oh, you know, is it over? Is it over? And then, okay, here we go. Uh-oh, should I get out? If we have a set of rules that go, well, we know when the trend ends. All we got to do is trail our stop up to these previous higher lows. And then the trend will tell us when it stops. And what we want to do is take profit along the way, but let the market, let the trend take us out. Tell us when it is over. That's what we want to do. And so that's why this is helpful in our trading. Okay, it sounds like Daniel got the audio back good. All right, I'll continue unless a bunch of people say there's a problem. I also use Ichimoku Cloud. I just use, you know, there's a lot of components to Ichimoku Cloud. Some people use it as a standalone trading system. I don't think it stands on its own very well as a trading system, but I like it better than moving averages. It's similar to moving averages. The way the components of Ichimoku Cloud are calculated. You know, a simple moving average is taking the average of the closing price, looking back X number of bars. Ichimoku Cloud is calculated with a short term and a long term, just like, you know, two moving line average, right? But they look at the average of the highest high and the lowest low X number of bars back. And so, and then it paints this shaded region here, right? It's green in an uptrend, it's red in a downtrend, and it predicts support levels for the trend until the trend is broken. When it breaks through, that's confirmation then of a trend change. So, man, I'm trying to catch new trends, looking for an entry somewhere down here, stay with it as it gets support, as we put in higher highs, higher lows, and then when it corrects, I want to trade that correction if there's sufficient profit available in the correction. So those are the three things I use together: Elliott Wave, Dow Theory, and Ichimoku Cloud. That's the core of my analysis technique that for me has added up to high probability trades setups. So again, I think you need to be a consistently profitable trader. You got to have great trade setups with high probability outcomes and a great reward to risk ratio. But let's look at, you know, how does that all lay out on a chart? What does it look like in real life? Well, here's a trade that we just got into, and it's, I want to show you a different one. USO is one we're also trading for sure right now. Let me go to a daily chart. Oops. I'm just having a hard time. Get that on a daily chart. Okay, Momo, Chinese internet company. So this is, again, I think I use a very simple version of Elliott Wave. And when I look at a chart like this, here's something that jumps out at me. This is a huge price move. It's kind of unmistakable, isn't it? It just went from July to August from $10 to $45. I think pretty much everybody listening would agree that that's a big price move. That's an impulsive move. That's an Elliott Wave 3 impulsive move. And what we see time and time again is after a big move, right, there's a shift in investor sentiment temporarily, and there is a correction. And the highest probability zone that it's going to correct to are these two blue lines here, this line and this line. These are Fibonacci retracement lines, 38.2 to 61.8 Fibonacci retracement. And then after we see the big impulsive move and then the correction, we start looking for evidence of the trend to continue, a continuation, a wave 5 of that original trend. And we look for Dow Theory, higher highs, higher lows, higher highs. Look, it broke the cloud. That's important. Higher low. Took off again. I would have taken this trade right here if I'd have seen it at that point. That would have been awesome. My first stop would have been here under a higher low. I just came across this trade. Actually, one of my subscribers pointed it out on Monday, And just like I mentioned earlier, I teach in my class, and I've trained my eye. When I pull this chart up, I instantly see a pattern, right? I see an Elliott wave pattern. Not every chart has it, and if it's not there, I just move on to something else. But I could spot that in a second and go, man, look, and impulsive move, a correction, starting to take off again. This looks like an awesome trade. Then we do some checking, and I think somebody's asking, how do you measure risk reward? It's an awesome question. You're a great straight person setup for me, because that is critical in my trading, measuring risk to reward. So I see this pattern, impulsive move, a correction, beginning of the continuation, wave 5. I can use Fibonacci extension lines. So I'm measuring the correction with Fibonacci retracement lines. I can now take Fibonacci extension lines and project a high probability, that's what I'm looking for, high probability target zone for wave 5. And the wave 5 target zone is a 61.8 to 100% Fibonacci extension. And so that's between $45 and $59. So we took our entry on this trade at Monday at 32.13. I have my stop under the last significant higher high, higher low. Okay, that's an important support area. I use the reality of price movement to place my stops. I don't place them arbitrarily 5 or 10% away or whatever like that. You know, what is a legitimate support level? Price reversed from here, went down to here and found support and reversed at the cloud. That's important. That's a great stop area. I took an entry at 32.13. My target, I put it, you know, kind of midway up into the target zone. Be a little conservative. We don't want to generate, you know, project maximum profit. We want to see if the reward to risk on the trade is good in a more conservative view. So the distance between my entry and my stop, that's my risk per share. That is my risk per share. If I go down, if I buy one share and it goes down and hits the stop, the trade fails, I will lose the difference between 32.13 and 26.08. You know, about just under $4 a share. That's what my loss would be. That's my risk. My reward is the distance between my entry and my target. Now, it's important to note, I do not get out just because it hits the target. The purpose of the target is to calculate reward risk. So I can look, we can just visually see on this chart without doing any math that the distance from my entry to my stop is that, and the distance from my entry to my target is that. Well, that's 3 or 4 times. That's a magnificent reward to risk ratio. The amount of money I'm going to make on the trade if it wins is much bigger than the amount I'm going to lose if it fails. That is exactly what I'm looking for. I think there's a couple questions. Let me try to catch up on that. Oops. John's asking, is this a normal time frame for Elliott wave to play out? How do you structure your own trades with this fairly long time frame? Each chart, John, has its own, it's dancing to its own drum, right? Some stocks are moving generally correlated to the overall market, but many others are dancing to their own drum. And so each chart has its own timing. Right? So what you're looking for is the patterns on that individual chart. It's not a fixed time frame that it happens within. Dennis asks, when my criteria is met, do I get in without hesitation? In addition to the setup here, this thing meets all my criteria on the setup on the screen in terms of the wave count, breaking above the Ichimoku cloud. You can see I've got a momentum oscillator on the bottom. I'm just confirming that there's sufficient upward volume. I do have the 200 SMA on here because it's the most popular indicator in the world and everybody's watching it, so I want to see what they're seeing and maybe how it might be affecting their behavior. So that's a 200 simple moving average, and this is just a price oscillator down here on the bottom looking for momentum. Okay, and we'll look at a couple of charts here in just a minute. And so we got in here 32.13. It's been a day or two consolidating, and then lo and behold, Momo announced yesterday that they were going to purchase a company in China, an online dating service, and the market applauded that move, and it jumped up. It was up over 17% at one point. So really good start. And we shattered through the 200 SMA. So I think we're on track here to hit the target. So this is awesome. Okay, so this is an example of what for me, using my trading method, a high probability setup with a high reward to risk. Man, I see a pattern here. It meets all my criteria. I've got a good price target. I got a clear stop. Rock and roll. That just works for me. I'm in. Odds of hitting the target. Good question, Dennis. About 65%. And that's a significant edge. Because if we're controlling loss, and if we have our winners on average being double the size of our losers, a 65% win rate, a 65% edge is serious, a serious edge, serious profitability. And that's what we're seeing. Okay, when do we start bumping up our stop? I'm going to talk about that in just a few slides in trade management. So let's get back on track here. I'm checking the clock. I don't want to run out of clock. Okay, so we looked at a live example here. So the next topic here is risk management. So I talked a little bit about placing my stop. I want to make sure I place my stop at a legitimate support level in an uptrend, and in a downtrend, a legitimate resistance level. Okay, so critical in risk management. I think most traders intellectually know this. You've probably seen this before. I've encountered a lot of people who don't practice it, right? But you have to determine how much you're willing to lose on a trade. And it has to be a pain-free level, an amount that would not be a setback, right? I use 2%. There's some significant risk of ruin tables where you can plot your win rate and your payoff ratio, and they suggest, based on serious statistics, what your risk amount per trade should be. So that 2% is not percent of capital in the trade. It's a different measurement. 2% is if the trade fails, what percent of my account would I lose? So on a $50,000 account, 2% of that is $1,000. So if you're using this guideline, you would say, if I'm trading with a $50,000 account and I lose 2% of my account, I will lose $1,000. And that's the maximum I'm willing to lose on any given trade. And that is a pain-free level. I can absorb that and continue trading, and it wouldn't be a setback. It wouldn't mess with my account too badly, and it wouldn't mess with my head too badly. That may be an okay level for you. Maybe it's less. I would be careful about going above that, right? So I determine the stop price first. I look on the chart and I say, what is the legitimate stop price? And here it's right under this, right? Higher high, higher low, new high. It's right here, 2608. That's the legitimate stop price. Then I take the difference between the entry and the stop, and I simply divide that into 2% of the account. Okay, 2% of the account. The difference between entry and stop is about $4. So if I'm trading with a $100,000 account, that means I have $2,000 that I'm willing to lose. I don't want to do it. I don't want to lose it, right? But I know some trades fail. That's a pain-free level on a $100,000 account. So I got $2,000. I divide $4 into it. I think I'll give you for 400 shares or something like that. Okay. Then you have to test and go, if it's $4 into 2,000, it'd be 500 shares, and I would go, okay, what's 500 times current price? And it's at $35. That may be too big of a position. I also am going to constrain my position size to no more than 15% of my capital in any one given trade, because we all know things can gap through the stops in a very rare case, but then that would be a tremendous setback. If you had 75% of your capital in one trade, that would be hard to recover from. So 2 constraints on the trade. No more than 2% of the account lost if it hits the stop, no more than 15% of the total account in any given trade. And then, John, great question. How do you calculate it with option pricing? I have 2 approaches. There's a basic approach. If you're new to option trading, would be simply only spend 2% of your account on option premium. So you got a $100,000 account. You got $2,000 that you can use to spend on option premium. If they're $500 a contract, you can go buy 4 of them. Okay, so that's the basic. The other is a little more advanced. You have to be able to use an option calculator and project what the price of the contracts would be at the stop if the trade fails. Take that, subtract it from the current price, and then divide that potential loss per contract into the 2%. So there's the answer, John. A basic and an advanced approach to position sizing with options. You're welcome. Okay, so we covered this. I said you need great trade setups, you need a high probability outcome, great reward to risk ratio, risk management. Let's look at a statistical model that I built. I confess I'm a bit of an Excel geek and a math geek, and I love building models like this. So I constructed this model from my last year's trading results. And I'll tell you what the assumption in here. So let's just assume a $50,000 account. It works with any account size, right? 2% risk that I just talked about, more than $1,000 loss per trade. Now, the actual loss per trade, because we're trailing our stops and stuff like that, the actual loss per trade is quite often less. Okay, so in my real trading last year at a $50,000 account level, the random loss was between $100 and $1,000, $1,000 always being the maximum. Okay, let's just assume a 60% win rate, right? 60% win rate, be conservative, with a random win between $100 and $3,100. So I'm taking trades, again, that have the potential to be on average at least double my losers, but sometimes they're better, and sometimes it doesn't work out. So these were actually again, at a $50,000 account level, these are the actual results in my trading last year in my live trading room. So losses between 100 and 1,000, wins between 100 and 3,100. So what I did was just constructed a model here that every time I press F9 on this spreadsheet, it takes 50 trades. And now, if the win rate, the long-term win rate is 60%, market conditions change, right? There's going to be some variability in that, in a particular sample, it won't always be 60%, right? What I did was built this little table down here using Excel's random number generator. So it generates a random number between 0 and 1. So if it's 0.40 or below, it is a loser. If it is 0.41 or above, it is a winner. That gives us a 60% chance of winning. And then a random P&L. If it's a win, it's a random profit between 100 and 3,100. And if it's a loser, it's a random amount between 100 and 1,000. Okay, and then we sum those up, and we also put those into bins so we can graph it in a bit of a histogram over here. And so here's what happens, right? I can hit F9, and Excel takes 50 trades, given those constraints that I just said, 50 trades, and it says, yeah, this time you had a 56% because, there's random variation, right? I tested this across 300 trades to make sure that it actually, was normally distributed data. And you can see it's got a median of 61, and it is perfectly normally distributed data. So it's pretty cool. So every time I press F9, it takes 50 trades, given those constraints, and says, hey, this time you had a 56% win ratio. You had a payout ratio, meaning the size of the winners in this sample was 4.35 to 1. They were 4 times bigger than your losers. Hey, you had a good 50 trades in a row there. The profit was really, really nice. Okay, so let's just hit F9 again. Yeah, not so good, but okay, right? You'll see 22,000. There's quite a bit of variance. But what do you see about this P&L number? What never, ever happens? Anybody venture a guess? I'll probably hit it 10, 20 times here. What never happens to that number? And there we have a pretty low one, 6,500. It's always positive. It never goes negative. Over 50 trades. Now this is this was a kind of a lousy sample. 34% win ratio, 1.6 payout ratio. We're still positive. We probably got some scary losing streaks. 3 losers, 2 losers. Right? It looks like probably the winners weren't that big, right? Ouch. What's that? 5, 6 losers in a row. That would have been tough to sit through, wouldn't it? Unless you knew based on real history and having modeled your system, improving your system, right, that it was okay, right? Because, hey, the next 50 we made 35 grand, right? We nearly doubled a $50,000 account, okay? So there's a couple things you have to do to make this model work, to make it real. And by the way, it is real. This is what I'm doing in my trading, right? And these are the kind of results we see on a $50,000 account across a multi-year period, okay? But to make this real, your winners do have to be bigger than your losers, and your losers do absolutely have to be controlled at the bottom, right? You gotta have risk control, because what happens if, you know, the two biggest mistakes I think that people are learning to trade make are not using risk control, so you end up with big losers, and that just hurts, right? It hurts your account. It's hard to come back from, and it hurts. You know, there's kind of psychological pain that you go through with a big loss, right? You feel remorse, you feel guilt, you know, you're afraid of taking the next trade. It really undermines your trading. So controlling loss is so important. That's one of the big mistakes traders don't make is they don't control loss. And then the other is the only thing, if you assume that loss is controlled, the other only thing that makes this model work is that your winners are bigger than the losers. And in order to have your winners be bigger than your losers, you have to first take trades that actually have that potential, like I just showed you on Momo. And then secondly, this is super hard. You have to stay in the trade. You have to let your winners run. I think it's harder for traders to do that than it is to, you know, get out at the stop. For some reason, I encounter a lot of people who, you know, like here, I guarantee you, I've got a couple hundred people following along with my stock picks. We took us a 17% jump on Momo. It was awesome. I guarantee you some people jumped out, took profit, right? That's a huge mistake, because that move, although it feels good, I just made 17%, right? Based on this daily chart, based on this price, right? Our stop is much farther away, right? And if you do that all the time, you'd get out and take profit when it jumps a little. I'll bet you're staying with the losers down to the stop, right? What did you just do? You just made your losers bigger than your winners. Uh-oh. That completely undermines this model. What happens if I make my winners equal to my losers? Just jumping out early, right? Well, I'll occasionally be profitable, but it's going back and forth. I'm pretty much, even at a 60% win rate, if my winners are equal to my losers, I'm kind of a break-even trader. Right? My broker loves me, but I'm not making any money. See the point? I think that's a cool model, huh? Geeks playing with toys, right? John, how do you create that spreadsheet? You love it. Yeah, Greg, in fact, you know, I take most of my trades. I do all my analysis on charts, right? It's all about the chart and the pattern. All my analysis takes place on the chart, and I get my stop, I get my good entry price, my stop, my target price, all my parameters are met, everything's good, and then I go find the ideal option contract and I trade it with an option. But all the cues for the trade, when to take profit, when to get out, stops, they all come off the underlying chart. Rob, yes, these concepts absolutely apply to day trading. It's irrespective of the instrument or the time frame. Day trading is hard, right? It takes ironclad discipline. It takes a proven trading system and ironclad discipline. It is super hard to sit there for 6 hours, right? And look at, you know, futures is the typical intraday trading instrument. It's the most popular. I knew there was a word, and there's good reasons for it, right? But there are days where you have to sit there and take absolutely no trade. That can be super hard and frustrating, right? So I've answered, I think, a lot of the questions. How many trades do I generally make in a month? You know, between my trading room and my stock pick service, 6 to 8 trades. And I trade, I'm showing this Momo on a daily chart. I trade 10-minute, 30-minute, 60-minute daily. How do I handle correlation? Correlation with what? I do look at intra-time frame correlation. You know, if I'm going to take a trade on a 60-minute chart, I'll go look at the big trend on the daily chart. If I'm going to trade a daily chart, I'll go look at the weekly. But I'm taking my cues. That's why, are we in the same trend, or am I, you know, I'm going long on the lower time frame, but it's really a correction to a bigger opposite, you know, trend, and I just want to know that. But all my trading signals are going to come off of one time frame. I trade long and short, man. Long and short. I want to make money both ways. We can make more money with a dropping market. We went short the SPY on January 31st, held it for 3 or 4 days, and I think most of you know how that resulted. That was a stunning win. Okay, where am I in the presentation anyway? Let's get back. These are great questions. I love talking to you guys. Okay, so we did the statistical model, right? The other thing we need is trade management. I know there have been a few questions about that. So you can get into a really good trade setup with great risk management. You can still lose money because you got to manage the trade. And I said up front, hey, you need to have a predetermined game plan about how you're going to manage the trade before you place the order and get into the trade. Otherwise, the actions are pretty likely to be driven by emotion. So great trade management includes taking profit at the right times, adding to the position strategically, staying with a winner for as long as possible, and exiting the trade at the right time. And I talked earlier about Dow theory. You can see, here's my entry. Here's my wave 3 entry. This thing's breaking out of a channel. This is a real trade I took, Vail. It's a great mining stock. Right, so we take our entries. It breaks out of the channel here. And then we have our initial stop. Remember, higher high, higher low. Initial stop here, higher high, higher low, new high, trail to stop, trail to stop. As price action plays out, we keep trailing, and then we get stopped out, and it's okay. Right? We can't catch the top. Who knows where the top's going to be? Let the trend take you out, and that's what we do. Okay, we take profit at key reversal points, and as we cross key Fibonacci lines, we'll take profit here. We'll take profit here. We get stopped out. Stunning win. Correction starts. Not enough profit in this one, so we just wait and we wait. Okay, here comes the continuation. Wave 5. Higher high, higher low. New high, breaking the cloud. Right? Rules are met. Initial stop here. Trail to stop. Right? Eventually, you know, we'll take profit as we cross key lines. We get reversals, and eventually we get stopped out. 2 big winners. That's how we do it. Okay, that's for trade management. Wow, starting to get an echo and some weird noises. Somebody opened the mic or something? Reading good now? Sounds like it. Okay. So I showed you Momo. I like Momo right now. I think it's a great trade. There is still plenty of profit left, plenty of room and time to get into it. Let me show you, I also like USO on a 60-minute. We bring the chart up. We got a little data issue here. I had it up earlier. I'll show you oil. You know what? My platform looks like it absolutely wants to crash, and that is going to bum me out. So am I still projecting and still live with audio and video and everything? Give me a yes, thumbs up or something. Yes. Well, that's good news. Thank you.
Yeah, Dan,
Bad news.
everything's been fine on my end. That's why I've not been chiming in because I think it's just a couple people having problems. You're good. You're all good.
Yeah, and but the bad news is TradeStation just crashed on me. And I was gonna look at people's charts for them. So that is a real drag. I'll give you the symbols. Yeah, I like USO on a 30-minute chart. We're long, and I'm looking for a setup on gold using GLD, the ETF. I watch futures contracts, and but I watch futures. I like the way they trade around the clock, but I don't trade futures. I would never hold futures overnight. I think there's a real risk in that. So I look at the futures contracts, and then I go trade with an ETF, which gives me a little buffer, and ETFs have great option markets. Okay, I was going to make a couple comments on options. So rather, just unfortunately, the TradeStation, you know, these things, right? Every platform has its little moments, right? Let me give you a couple thoughts on options. And then I'll field a few questions, and then I will yield the floor for the next speaker here coming up. So options. Yeah, anybody ever heard, you know, someone say, all option buyers lose money, 90% of options expire worthless. If you buy options, you're going to get killed by time decay. You're paying too much for volatility. Have you ever heard comments like that? Or maybe you believe that. Give me a thumbs up or a yes on that. Yes. The yeses are flooding up all the time. Well, you know, the statements are true, right? Yes. If you buy the wrong option contracts and the wrong strategy, you could pay for volatility. Yes, they could expire worthless at $0. Yes, you could lose money on time decay. Those are all true statements. If you have the wrong strategy, I won't use the word dumb. They could happen, but if you have the right option strategy, those things do not have to be true, right? There's three things that make up the price of a contract: implied volatility, time, and then the strike versus the underlying, how much it's in the money, right? And these are in two categories: extrinsic values and intrinsic. So extrinsic value in an option contract is it's not part of the essential nature. It's made up from volatility and time. Intrinsic, you know, is the actual value of something. And if you think about a silver dollar, right? How much is a silver dollar always worth, regardless of anything else? It's always worth $1, right? It may have additional extrinsic value because of its rarity or condition to collectors, but it's always worth $1, right? And so it's the same thing with option contracts. The degree to which a contract is in the money is its intrinsic value, and it is always worth that, right? Extrinsic is based on time and implied volatility. Right, so if you have a call option, you have a strike price of $100 and price is sitting at 120, it has $20 of value that is non-negotiable, period. Right, you have the right to go buy stock at $100. It's trading at 120. It's got $20 of value. Call option the same way. Right, if you have a strike price of 125 and current price is at 95, it has $35 of intrinsic value because you can go sell shares for $125 that are trading at 95. Right. So time value in options, there is such a thing as time value decay. It decays more rapidly in the last 30 days. So it is not a linear decay, but it is nonlinear. And the total value of an option contract is the sum of its extrinsic and intrinsic value. And if it is purely, if you have an out-of-the-money option contract, it has zero intrinsic value, its price is comprised 100% of extrinsic value. So it is subject entirely to implied volatility and time decay. So this is the kind of contract you're buying out of the money, and it never goes in the money, and time in the last 30 days of the contract, a ton of value is going to bleed off of this thing, and if volatility goes down, a ton of value is going to bleed off that way. But but this time decay and IV only apply to that extrinsic value portion, and price determines the intrinsic value. Again, this is what it's worth. This is the degree to which it's in the money. And then, of course, there's my Greek helper delta. So high delta, it simply means how much will the options premium change in a result from the underlying security change, right? And you see some examples here of high delta, low delta, and near zero delta, right? That high delta has high intrinsic value, it's axiomatic, right? And if we're paying for things, if we're doing a directional trade and we, let's look at a guild example right here. If we have a setup and a high probability and an edge, and we think, I think Gilead Sciences, based on my analysis, is going to 90 bucks. Well, which one of these makes sense to go buy then? Pure extrinsic value, which the price of the contract is not going to go up as price goes up, right? Low delta or high delta. High delta means if this price goes to 90, the price of this contract is going to skyrocket, right? And the amount that we're exposed to time and volatility value is small, and it gets smaller and smaller and smaller. So even if we get out toward the end of the contract, in the sense playing out, right, the amount that intrinsic value is increasing because it's a high delta contract will more than outweigh the fractional amount that's coming off due to time. So that, you know, the outcome of all that discussion is I buy high delta, deep in the money, way out in time contracts when I've got a directional trade. Yes, you will pay more for them. You can go get out of the money contracts for super cheap. If this thing costs 500 bucks, this one probably costs 50 bucks. This one is super expensive because it's probably going to lose you a lot of money. This one is super cheap because it's probably going to make you a lot of money. So that's kind of my tagline is cheap contracts can cost you an awful lot of money. If I'm wrong, don't I lose more? Well, I've controlled my risk to the downside, John. So I've determined where my appropriate stop on the chart is. I've only put in the amount of money into the trade and the potential loss at the stop that I'm willing to endure. So if I hit that, I just get out. Go sell to close. Right? So we control risk. And if we're right, it's going to be so if I get, you know, say these are $500 contracts and I buy, you know, 2 of them for $1,000 and a $50,000 account. If I go down and hit the stop, I'm typically going to lose $400 or $500, right? So I have $1,000 in the trade. I'll lose $400 or $500. That's less than 1% of my account. That's a tolerable loss. If I'm right, they're going to double or triple in value. I'm going to make $2,000 or $3,000. That reward to risk works for me. $2,000 or $3,000 in profit versus $400 or $500 loss. And if I'm winning more than I'm losing and I'm having that kind of payout ratio, life is good. So I think I'm pushing up against the clock. So let me get here to wrap it up. I'm really sorry I couldn't look at charts, but out of my control technology is so seductive until it doesn't work, right? So if what we talked about in terms of the approach and the trades I showed you, some of you get excited about that. Looked like people were engaged. We had some great questions popping in. But maybe I went fast. There was a lot of information. Maybe you feel like this guy here. I got an offer for you, a way to participate in my trades. It's I have a stock and option pick service. So I'll just jump right to it, right? And here's the things that, again, we said are essential, right? Great trade setups, risk management, trade management, right? I'm going to offer you those 3 things: great trade setups, great risk management, great trade management. I offer this stock advisory service. We take 1 to 2 trades per week. I send the picks out that I'm going to trade, and I'm trading these in my own account with my own money, and I'm audited by an external firm, a CPA firm, to confirm that I'm actually doing that. And the results are on my website year after year after year, and the audit reports are there as well, followmetrades.com. But you can try my stock and option picks for 30 days for $37. I provide both the stock trade parameters and the option trade parameters for every pick. There's a 100% money back guarantee. Try it out, you know, $37, 30 days. If it's not a good fit, you just shoot me an email, call our support line, money's back in your account, no hard feelings, no questions asked, right? So you can click the link in the chat box. Let me see. I don't know if it got posted for me, but I can throw that thing in there real quick. There's the link. Type it and paste it to everybody. There it goes. So you have that link, and it's typed out there. It's a short URL. So with the stock and option pick service, I send the picks that I'm taking on my own account, 1 to 2 trades per week. They're posted on a website. You get an email with the details, and you can opt in, and you can get it sent to your phone via text message if you would like that. Every Wednesday night, we have a live chat session where you can log in, and we walk through the charts, answer questions, do some education. When you sign up, you are offered a free one-on-one consultation with me. We jump onto a Zoom meeting where I can share my screen, we can talk, walk through the website, walk through the trades, answer any questions that you have. So you get a free consultation, Wednesday night, live chat session, 1 to 2 picks per week, and up management through the life of the trade. You get the parameters to trade stocks or options, whichever you like, updates on the trades. I provide a bunch of tools for risk management, option management, trade management, all that kind of stuff. So that's all included in the service. And after the 30 days at $37, then it's $97 a month, as long as you have a current subscription. List price on the website is $127, so this is a 25% discount. I got great picks that have entries right now. So you jump in, you will get access to those, and I'll be publishing some more over this weekend. So there's the link. Again, the tiny URL, and I've got it posted. And if anybody's interested, I look forward to having you join and to having a consultation with you and get started sharing in my success. I'm having fun, and we're making some pretty nice profit. And I think, Jeanette, that's about a wrap for me.
Hey, yep, I'm right here. Are you there?
Yeah.
Okay, yeah, I just posted your link for you, and I posted it into the main area for everybody. I don't know if you did too, but thank you, Dean. I appreciate you coming today. We definitely will invite you back, and I'll keep posting your link as we move forward through the rest of the morning, and then of course I'll post it with the recording.
Okay.
All right, thank you, and have a good morning. And I'm gonna take the control back. I'm gonna take my power back. Hang on.
All right. All right.
All right.
Hey, thanks, traders, for sitting through. I really enjoyed all your questions and engagement. It's awesome.
Yeah, let's see. Make myself the presenter.